Why so many banks are ready to collapse? Have you ever thought about why so many banks are so close to failing? This movie goes into great detail about the main reasons behind the banking crisis and shows the weak spots that could cause a financial collapse. What is putting these banks on the verge of failure, and how might this affect your interests and savings? Stay tuned to find out the scary truths about why the banking sector is so unstable and what you can do to stay safe. America experienced the biggest number of bank closures since the 2008 financial crisis in 2023. The reason so many banks closed in 2023 was a result of a number of factors, including a rise in the usage of mobile banking, inflation, interest rates, and real estate difficulties. Due to these problems, Silicon Valley Bank failed in March 2023. A few months later, First Republic Bank and Signature Bank also failed. These banks' combined assets totaled hundreds of billions of dollars. Unfortunately, these issues are still present in 2024, which has many people concerned about the general safety of financial institutions nationwide. According to the FDIC's failed bank list, the number of bank failures has continued, and as a result, the economy is still having difficulties. What's causing bank failures? One essential component of the economy is the bank. From tiny community banks to major corporate holdings, these organizations have a significant influence on how commerce is conducted in the United States. This is why bank problems have the potential to quickly devastate a population. However, why are banks closing their doors? The depreciation of bank assets. Possessions of banks include cash, investments, loans, and reserves. Banks may close if they don't have enough assets to cover their obligations and other operating expenses when these assets lose value as a result of rising interest rates. Economic factors. Slower economic growth or decreased consumer spending is another effect of higher interest rates. Bank closures can result from recessions, housing market meltdowns, and inflation. Regulation. Following the 2008 financial crisis, banks are required to abide by a number of government rules. In particular, in the event that an insured bank fails, people are protected by the FDIC from losing their deposits. Bank branch closures are more likely if these agencies implement stronger restrictions, or in the worst situation, if congressional oversight is established. Technological developments. Bank closures have also been brought on by online and mobile banking. More branch closures have resulted from brick-and-mortar establishments struggling to make ends meet as internet banking has grown in popularity. Why are consumer accounts being closed by banks? Banks are also canceling consumer accounts with no notice, according to more bank closure news. The rise in fraudulent activities is the primary cause of this increased frequency. To keep themselves from losing money, banks have started clamping down on any kind of potentially risky conduct. A lot of US banks are also suddenly freezing accounts that haven't been used in a while. This serves as a kind of preventive action to protect their assets and lessen the likelihood of bank failures as a whole. Close-up of credit cards and cash. By avoiding unforeseen and hidden costs from alternative cash handling services, you can reduce your overall expenses. Does a recession follow bank closures? Failures of banks do not always indicate a recession. Recessions and economic collapse, however, can be caused by a variety of variables in addition to a problematic banking environment. A rise in financial strain may force further small banks to close, which would have an impact on personal accounts, small business financing, and the health of the economy as a whole. Bank failures did play a role in the 2008 crisis, but lending to borrowers who wouldn't have qualified for loans was a major contributing factor. Increasing Federal Reserve inflation, bank failures, and ultimately the fall of Lehman Brothers in late 2008 added to this. The recession was brought on by all of these variables together. The effect of bank closure on the economy. Bank closures have a ripple effect on the economy as a whole, but they can also negatively impact individuals, their assets, and businesses listed on the FDIC problem bank list. Companies will need to alter the way they handle and invest their funds, and people might discover themselves in a banking desert where there are no banks within 10 to 20 miles. Bank closures can have a significant impact on housing and jobs as well. Monetary contagion. An economic crisis that spreads from one market, region, or nation to another is known as financial contagion. All facets of the economy, labor, inflation, products and services, and financial markets are frequently impacted by this. Good economic markets frequently allude to negative effects from other nations or economies, even though they can also strengthen neighboring markets and cause financial contagions. For instance, the 2008 recession had a wide range of effects on the world economy. Runs on banks. A bank run occurs when consumers fear that the bank or economy will lose money and that they would then make a run to take all of their possessions. It sounds like a scene from It's a Wonderful Life. For banks, this can swiftly turn disastrous since they stand to lose nearly all of their assets right away. Customers may force a bank to collapse if they learn about the business's difficulties. This is precisely what happened to Silicon Valley Bank in 2023. Changes and increases in unemployment. Employment is another additional economic effect of bank crisis. When the economy is struggling, a lot of companies will dismiss or lay off workers, which might cause financial catastrophe since people won't have enough money to buy. This contributes to the financial crisis together with firms not boosting the economy. Digital obstacles for clients with disabilities. While more people are banking online, this presents challenges for people with cognitive, visual, and hearing impairments, as well as for those with mobility impairments. Many apps and websites rely on users to interact and comprehend them intuitively, and thus frequently lack the necessary accessibility features for a large number of users. Extended journeys to banks. The phenomenon of bank deserts, wherein an increasing number of physical banks close their doors, has an impact on the accessibility and ease of travel for individuals to banks. Many people rely on public transportation, which can be unreliable and takes significantly longer, while others can easily drive to one. Behind the teller glass, a bank employee counts $20 bills. Armored car service costs are just one expense. There are other fees associated with banks and logistics. Enhanced banking connections. Growing numbers of bank closures frequently result in a greater demand for banking ties. Businesses may need to rely on partnerships with many banks due to proximity, for instance, if they have multiple locations. This raises stress levels and the possibility of accidents while adding another level of complication to bank fees and banking procedures. Rising fees for financial services. Having several banking ties or even just using more services at one place might drive up the cost of using the bank. Additionally, many financial institutions have raised the cost of their services in an effort to reverse the economic slump, which means that people and businesses now have to worry about paying more for necessities that they used to pay less for. A smart safe is more than just safeguard cash. Find out how hash capture technology can help you get cash faster. Which banks face danger? Although many banks keep this information confidential, it can be difficult to predict which banks may be in danger of closing, but there are a few warning indicators you should be aware of. Among them are declining stock prices. A decline in bank stock prices frequently portends a future closure. Recessions and other economic downturns frequently have a direct impact on equities, thus a declining stock price may be a sign that your bank is about to fail. Inaccurate or inaccessible reporting. Another indicator of an imminent collapse may be your bank starting to make it harder for you to get account information, or if you see information that isn't accurate. Drop in profits. When banks are able to invest consumer money at a higher interest rate than they were paid for it, they profit. In addition, they receive revenue from service fees and interest rates. Thus, it is another indication of possible failure if they are losing money in spite of these sources of income. Increasing loan defaults. Lastly, if you observe a high number of loan defaults at your bank in a brief period of time, this frequently indicates a decrease in revenue as well. Significant bank closures occurred in 2023, and a lot of people are worried that 2024 will see more of the same. All of this, though, is dependent on how banks, people, and companies handle the present state of the economy. Is there a way we can make the economy more profitable in spite of these bank closures? How can you safeguard your possessions against the possibility of branch or bank closures? If you want to stay updated on the latest financial insights and learn how to safeguard your money in these uncertain times, be sure to hit that subscribe button and turn on notifications. Don't miss out on our expert analysis and advice.